So picture this. You buy a homeowner's insurance policy or, maybe auto insurance,
Right.
and you pay your premiums year after year faithfully. I mean, over a lifetime. That adds up to a massive amount of capital just flowing straight from your bank account to the insurer.
Oh, absolutely. It's a huge chunk of change.
Yeah, so naturally, it begs the question, right? Does all that money make you like a part owner of the insurance company? Do you get a say in the overarching strategy or, I don't know, a cut of the profits when they have a good year?
Well, it's a completely logical assumption, honestly. I mean, you're essentially funding the entire operation.
Right.
But the reality of the financial structure reveals a starkly different picture. In the vast majority of cases, the answer is just an absolute no.
Wow.
Yeah, you don't own a fraction of an inch of that company, and you have exactly zero say in its governance.
Which brings us to the foundational concept we are decoding today in this deep dive, the stock insurance company.
It's a huge topic.
It is. And we want to welcome everyone listening. Whether you're, a CPCU student cramming for an exam, an insurance professional, or just someone insanely curious about how the financial world actually works behind the scenes.
Yeah, it's great to have you here. This stuff is kind of the hidden mechanics of the whole industry.
Exactly. So to understand the stock insurance company, we need to look at it through the lens of a comparison I always find really helpful.
Okay, let's hear it.
Think about the fundamental difference between shopping at Apple and shopping at Costco.
Oh, yeah, the classic retail divide.
Right. So if you walk into an Apple store and you buy the newest iPhone, you are engaging in a purely transactional relationship. You are a customer.
Right, you're buying a product.
Exactly. Buying that phone, even if you buy like 100 of them for a business, it does not make you an owner of Apple. You don't get a vote on who runs the company or what the next iPhone looks like.
Which is a shame, really.
Right. But to get those governance rights, you literally have to open a brokerage account and buy Apple stock.
And that, right there, is the exact model of a stock insurance company. The person buying the insurance policy is the iPhone buyer.
Okay.
You're purchasing financial protection, which, makes you a customer. The person who buys the stock, the shareholder, they are the owner.
Got it.
But to finish your metaphor, Costco operates on a fundamentally different premise. You actually have to buy a membership just to shop there.
Yeah, you show the card at the door.
Exactly. The members are the lifeblood of the organization. And the whole structure is designed to return value to those members, primarily in the form of lower prices and bulk deals.
Right. And in the insurance world, that Costco model is the mutual insurance company, where the policyholders are actually the owners. But we are focusing on the Apple model today, the stock insurance company.
The Apple model, I like that.
So let's just establish the textbook CPCU definition for those studying the mechanics. A stock insurance company is an entity owned by shareholders, stockholders, who elect the board of directors and share in the company's profits through dividends and stock value appreciation.
Yeah, and the defining characteristic there is the separation of roles. It's the great ownership divide.
The divide, right.
In a stock company, the policyholder and the shareholder serve completely different economic functions. I mean, it's entirely possible to be both.
Wait, really?
Oh, sure. You could buy an auto policy from a major publicly traded insurer and then just go to the stock market and buy 100 shares of their stock.
Oh, okay. I see what you mean.
But simply holding the policy gives you exactly zero ownership rights. Your policy is just a contract for risk transfer.
That separation of customer and owner isn't just like some legal technicality, though. It actually dictates the entire business engine.
Oh, 100%.
Because if the shareholders are the true owners, the company's primary financial mandate is to generate profit and increase shareholder value.
Yes, yes. They demand long-term growth and a return on the capital they risked by investing in the first place.
So how does that mandate change the day-to-day operations of the insurer? Let's look at pricing for a second. When a policyholder gets a premium bill in the mail, what specific mathematical buckets is that money filling?
Well, it is an incredibly precise actuarial calculation. In a stock insurance company, those premiums must be sufficient to cover 4 very specific elements.
Okay, lay them out for us.
First, expected losses. This is basically the actuarial prediction of the money they will eventually have to pay out for claims.
Makes sense. The core product.
Exactly. Second is operating expenses. That's the overhead, the underwriting staff, the technology infrastructure, even the cost of acquiring the business.
Right, keeping the lights on.
Yep. Third is a really fascinating one, actually, investment risk.
I want to break down that investment risk bucket before we hit the fourth one, because insurers don't just, put premium dollars in a giant vault Scrooge McDuck style.
No, they definitely do not.
They invest that money usually in bonds and sometimes equities to generate a yield before they actually have to pay it out in claims.
Right, the time value of money.
But those financial markets carry their own risks. I mean, if the bond market fluctuates, the insurer still owes the policyholder the exact same amount for their claim.
Yes, they do.
So they have to price a margin into the premium just to account for the risk that their investments might underperform.
Precisely. The time horizon between collecting your premium and paying a potential claim allows them to invest, but the volatility of those investments requires a built-in pricing buffer.
Interesting.
And that leads directly to the fourth bucket, which is completely unique to this corporate structure, shareholder return.
The profit?
Exactly. The premium must be priced high enough, after accounting for all those claims, expenses, and investment risks, to leave a margin of profit for the people who actually own the company.
Okay, now I have to play devil's advocate here on behalf of anyone listening who just heard, we price your insurance higher to pay our investors.
Go for it. It's a fair point.
If my premiums have to generate shareholder returns, doesn't that inherently incentivize the insurance company to be incredibly stingy when it comes to paying my claims?
It seems like it would, right?
Yeah, like if they deny a borderline claim, doesn't that directly translate to more profit for the shareholders that quarter?
It is honestly the most common critique of the stock model, but it totally misunderstands the mechanism of insurance regulation and contract law.
Okay, explain that.
Well, claims are paid according to the specific terms of the insurance policy, which is a legally binding contract. If the contract stipulates coverage for a specific loss, the company is legally obligated to pay it, period.
So they can't just wiggle out of it.
No, and state regulators monitor claims practices aggressively. A company that systematically denies valid claims just to boost quarterly profits will face massive fines, endless litigation, and they could potentially lose their license to even operate in that state.
So they can't just arbitrarily decide, hey, we'd rather issue a larger dividend this quarter, so let's reject all these roof damage claims.
The legal and reputational exposure would be catastrophic.
Right.
Where the profit mandate actually materializes isn't in wrongfully denying valid claims on the back end. It materializes in underwriting stringency on the front end.
Ah, okay. The front end.
Yeah, management is hyper-focused on pricing the risk accurately before the contract is even signed. They want to ensure they are taking on risks that, in the aggregate, will be profitable. And they focus intensely on the mechanics of reserve adequacy.
Let's unpack reserve adequacy, because this is where the financial engineering gets super complex. Reserves are the massive pools of money set aside to pay the claims they know are coming, right?
Right, or even claims that have happened but haven't been reported yet.
And shareholders demand highly accurate reserves.
Oh, they demand perfection, honestly. If an insurer underestimates its reserves, meaning they just haven't set aside enough money for future claims, their current profits look artificially high.
Because they're holding on to cash they actually owe.
Exactly. But eventually, those claims come due. And when the company is forced to suddenly pull capital from somewhere else to cover that shortfall, profits just plummet, the stock price crashes, and the shareholders lose their investment.
Ouch.
Yeah. So balancing that pursuit of profit with the absolute necessity of financial stability is the tightrope management walks every single day.
Which brings us to what I like to call the capital superpower. We established the mutual company, the Costco model owned by policyholders, and the stock company. Stock insurers have an immense structural advantage when it comes to managing the balance sheet.
They really do. It is their ability to manipulate capital.
Right.
Capital, in the insurance context, represents the funds used to support operations, guarantee claim payments, and absorb those big unexpected losses. If a stock insurance company needs a massive influx of capital, they have a mechanism mutuals simply do not have.
And what's that?
They can issue new shares of stock and sell them to investors on the open market.
To understand why that is such a superpower, we need to look at the alternative. If a mutual company wants to grow its capital base, it generally has to rely on retained earnings.
Yep, saving their pennies.
Right. It has to slowly accumulate profits from its insurance operations over years, sometimes decades. It is a slow, methodical burn.
whereas a stock company can tap the global financial markets almost instantly.
Wow.
Let's say a stock insurer identifies a massive opportunity to expand into a brand new, highly complex market, like underwriting commercial space launches or, global cyber liability.
Something that takes a lot of cash.
Exactly. That requires an enormous amount of upfront capital to satisfy regulatory requirements before they even write their first policy. Or perhaps they just want to acquire a major competitor.
Right.
They can issue new shares, raise billions of dollars from institutional investors practically overnight, and execute that strategy.
But it's not just an aggressive growth tool, is it? It is the ultimate survival mechanism.
Oh, for sure. Think about catastrophes.
Yeah. Right. Consider a catastrophic loss scenario. A Category 5 hurricane hits a densely populated coastline, resulting in, let's say, $10 billion in claims for a single insurer.
A nightmare scenario.
The company pays those claims out of its surplus. And surplus, fundamentally, is just the excess of their assets over their liabilities. It is the financial shock absorber.
And a hurricane of that magnitude compresses that shock absorber significantly. When the surplus drops, the company's financial leverage ratio spikes.
And regulators do not like that.
No, they do not. Regulators, specifically state insurance departments, using coordinated standards from the NAIC, the National Association of Insurance Commissioners, they monitor that ratio constantly.
So if the surplus drops too low relative to the amount of premium the company is writing, the regulators step in.
Exactly.
They will force the company to stop writing new policies, which effectively halts their business engine entirely.
To avoid that regulatory freeze, the company has to replenish the surplus immediately. A mutual company in that scenario is in a very, very precarious position.
Because they can't just issue stock.
Right. They might have to purchase extremely expensive reinsurance to offload risk because they cannot conjure new capital out of thin air.
But a stock insurer.
A stock insurer, however, can execute a secondary stock offering. They bring in fresh capital from investors, instantly inject it into their surplus, satisfy the NAIC requirements, and continue writing new business without a structural freeze.
The financial flexibility is just unparalleled.
It's their biggest advantage.
So let's bring all this macroeconomic theory down to a concrete level. I want to walk through the complete life cycle of a dollar in this ecosystem, just to see exactly how the mechanics work. Let's create a hypothetical entity, the ABC Insurance Company.
Okay, ABC Insurance. The life cycle begins with capitalization.
Right.
ABC Insurance decides to organize as a stock insurer. They issue shares to initial investors, successfully raising, let's say, $2 billion in capital.
Nice even number.
Yep. That $2 billion sits on the balance sheet as the foundational surplus.
Okay, then operations commence. Backed by that $2 billion surplus, ABC Insurance enters the market and sells homeowners policies to 1 million customers.
A great first year.
Right. Those 1 million policyholders pay their premiums, transferring their individual risk of a house fire or wind damage directly to ABC. But to reiterate the core distinction here, those 1 million people are merely customers.
Yes. They hold contracts, not equity.
Got it.
So, as the year progresses, the business engine runs. ABC collects the premium revenue, pays out the actuarially expected claims, covers their operating overhead, and earns a return on the premiums they invested in the bond market.
Because their underwriting was disciplined and their pricing was accurate, the revenue exceeds the outflows.
Exactly. They generate a net profit.
So we have this pool of profits sitting on ABC's balance sheet at the end of the fiscal year. In a stock company, the allocation of that profit follows a very specific corporate governance framework. It generally flows down one of three avenues. The first avenue is reinvestment. The profit is kept as retained earnings to fuel internal growth, like maybe building a proprietary AI underwriting model or expanding operations into 3 new states.
Which is always good for the long term. The second avenue is external expansion through corporate acquisitions.
Buying up the little guys.
Exactly. They use the cash to buy a smaller regional insurer to instantly acquire market share. Now, both of these first two options retain the capital within the company, theoretically increasing the overall value of the stock, which benefits the shareholders indirectly.
Right. The stock price goes up. But the third option is the direct payout.
The dividend.
Let's talk about that.
A stock dividend is a direct proportional distribution of corporate profits to the individuals and institutions who hold the stock. So if you own 10% of the outstanding shares, you receive 10% of the declared dividend payout.
It is the purest realization of shareholder return.
Absolutely.
But this is where a massive point of confusion often arises, especially for people navigating the terminology for the first time. The word dividend means two entirely different things depending on the corporate structure.
Oh, this is a huge trap for students.
Yeah. In our ABC insurance scenario, a stock company, a dividend, is a payment to Wall Street investors.
Yeah.
But you will often hear mutual companies heavily advertise that they also pay dividends.
It is a critical distinction in insurance mechanics. Some mutual insurance companies will occasionally pay what are formally called policyholder dividends.
Okay, how does that work?
Well, if the mutual company has a highly profitable year with fewer claims than expected, they might return a portion of that unneeded premium back to the customer owners.
So it's basically giving them their own money back.
Exactly. The IRS actually treats a policyholder dividend largely as a refund of overcharged premium, not as investment income. Yeah, a stock dividend, however, is a distribution of corporate profit to investors and is taxed as investment income. They share a name, but the financial mechanics and tax implications are entirely different.
And the decision on which avenue to take, whether to reinvest, acquire, or pay a stock dividend, that does not happen democratically among the customers.
No, definitely not.
It is executed through corporate governance. The shareholders elect a board of directors, and the board has a fiduciary duty to act in the best financial interest of those shareholders.
Right. They hire the executive team, set the risk appetite, and decide exactly how to allocate the profit.
This complex web of governance, capital flexibility, and ownership rights is exactly why this concept is so heavily scrutinized in professional education.
Oh, you see it everywhere in the coursework.
Right, for anyone listening who is actively preparing for industry designations, whether it's the foundational CPCU 500, the operational focus in CPCU 520, the complex finance in CPCU 540, or even the AIAF reporting tracks. This structural divide is just a cornerstone conceptual requirement.
You absolutely have to know it. The examinations won't just ask for a basic definition. They require you to analyze scenarios based on the downstream effects of these structures.
So how do they usually frame it on the test?
The testing framework almost always forces a comparative analysis. Stock insurers versus mutual insurers. You have to evaluate how they behave differently across three specific pillars: ownership, capital, and profits.
Okay, let's analyze the conceptual divide for each pillar. Starting with ownership, the exam will test your understanding of governance, right?
Yep. In a stock company, the shareholders possess the voting rights. They control the board. In a mutual company, the policyholders technically hold those voting rights.
Even though in practice, voter turnout among mutual policyholders is vanishingly small.
Oh, it's virtually non-existent. But legally, they hold the power.
Okay, so the second pillar, capital. This is where the scenario questions get intricate.
Definitely. The exams will present a situation where an insurer suffers massive catastrophic losses and needs immediate liquidity.
Like our hurricane example.
Exactly. You have to recognize that the stock company's ability to issue equity shares provides a rapid capitalization mechanism, whereas the mutual company is constrained. They're relying almost entirely on slow surplus accumulation or, expensive debt instruments.
Right. And the final conceptual pillar is the allocation of profits. Exam scenarios will test your understanding of fiduciary duty.
Right. A stock company's management is legally bound to pursue strategies that ultimately benefit the shareholders. Period.
Whereas a
mutual company's management operates to benefit the policyholders, which usually translates to prioritizing long-term stability and lower premiums over aggressive high-risk expansion.
Now, exam writers love to set traps. I remember this one clearly. A classic misdirection is presenting a scenario where a massive multinational corporation purchases a $50 million commercial liability policy from a stock insurance company.
Oh, I've seen this exact question.
The question will ask what specific governance rights or profit-sharing authority that massive premium grants the corporation.
And the trap is assuming that the sheer size of the premium alters the structural relationship.
Exactly.
It does not. The answer is always none. Regardless of whether you pay $500 for a basic auto policy or $50 million for a global commercial risk portfolio, if it is a stock insurer, the policyholder remains strictly a customer.
No board votes.
No access to shareholder dividends, nothing.
So having mapped out this rigid divide between the stock model and the mutual model, we need to introduce the ultimate structural curveball.
Because the financial markets are never entirely static?
No, they aren't. a company isn't permanently locked into its original structure.
Right. And understanding how a company transitions between these states is totally vital for grasping the broader movements in the financial sector. The mechanism is called demutualization.
Demutualization.
Yeah.
So this is the legal and financial process by which a mutual insurer strips away its policyholder-owned structure and converts itself into a publicly traded stock insurance company.
Yes. It is a massive, multi-year undertaking. It involves intense regulatory scrutiny, insane actuarial valuations, and heavy legal restructuring. They fundamentally rewrite the corporate DNA.
But why would a board of directors, who are currently answering to policyholders, voluntarily subject themselves to the volatility of Wall Street, quarterly earnings calls, and the relentless demand for shareholder profit? Like, what drives a company to take on that headache?
It always traces back to the capital superpower we talked about. A mutual company might reach a strategic inflection point where its lack of capital flexibility becomes an existential threat.
Like, they literally can't survive without a massive influx of cash.
Right. Perhaps they are losing market share to aggressively expanding stock insurers, or perhaps they need to overhaul their entire legacy technology infrastructure just to survive the next decade, and the cost is measured in the billions.
And their slow burn accumulation of profits, the retained earnings, just isn't generating enough capital fast enough to fund that survival strategy.
Precisely. By executing a demutualization, they unlock the vault. They transition to a stock entity, issue an initial public offering, go to Wall Street, and raise billions in fresh capital instantly.
They trade the insulated stability of the mutual structure for the aggressive growth potential of the stock market.
Exactly.
It perfectly illustrates how deeply capital requirements dictate corporate strategy. Let's synthesize the mechanics we've explored today.
Let's do it.
The foundational takeaway is the absolute separation of roles in a stock insurance company. The individual buying the protection, the policyholder, is a customer. The individual holding the equity, the shareholder, is the owner.
And because of that specific corporate governance structure, the entire operational engine is calibrated toward generating profit and increasing shareholder value.
Which dictates meticulous actuarial pricing to include profit margins.
Right, and strict underwriting standards to ensure aggregate profitability, plus an intense focus on maintaining accurate reserves so profits aren't just an illusion.
But the trade-off for that relentless profit pressure is unparalleled financial agility.
The superpower.
Right. The unique ability to issue shares on the open market provides stock insurers with a mechanism to rapidly fund acquisitions, expand globally, and quickly rebuild their surplus after catastrophic events, avoiding the regulatory freezes that can totally cripple mutual companies.
Understanding that structural difference isn't just about, passing a CPCU examination. It is about understanding the fundamental drivers behind the decisions these massive financial institutions make every single day. The ownership structure dictates the behavior.
Well said. Thank you for joining us as we navigated the mechanics of the stock insurance engine. For those of you utilizing this deep dive for your CPCU or AIAF studies, you now have a comprehensive understanding of a core curriculum pillar.
And as we conclude, I just want to leave you with an analytical thought regarding demutualization. We discussed how it unlocks capital for the company, but consider the perspective of the mutual policyholders during that actual conversion.
Right, the people who technically owned it before.
Exactly. If you held a theoretical ownership stake in a mutual company and the board decides to demutualize just to appease Wall Street, the legal process actually requires compensating you for the loss of that ownership.
Oh, wow.
Yeah, so it forces you to ask, how do you accurately calculate the exact financial value of a policyholder's voting rights and ownership stake? And how does the company ensure those former owners aren't just shortchanged when the Wall Street investors take control?
Man, it is a massive transfer of equity and power that fundamentally redefines the relationship. Definitely something to consider the next time you look closely at your insurance contract.